Well, today I wanted to talk about the Reserve Bank's response to the COVID-19 crisis. It really started on the 19th of March when they announced a series of policies. The first one was that they would cut the target cash rate to 0.25%, and they indicated they saw that as the effective lower bound, and there was no appetite whatsoever to go negative. So it appears that that is the low rate that the Reserve Bank will be achieving in this cycle. Secondly, they indicated that they would be targeting the 3-year bond rate also at 0.25%. And they chose the 3-year bond rate because they saw the 3-year part of the curve being the benchmark part of the curve that is most relevant to Australian private investors, and we certainly support that choice. Of course, it's interesting that they chose 0.25% for the bond rate and the cash rate, and that has a fairly clear implication that they expect the cash rate to remain at 0.25% for several years. They also committed that they would not raise the cash rate until after they had adjusted the 0.25% target for the bond rate. Interestingly, of course, if one looks at that and says, well, that's the bottom of the cash rate, then I expect there will be an aggressive move from mortgage borrowers from floating rate mortgages to fixed rate mortgages if the pricing is attractive. The third important development was to provide $90 billion, about 3% of total assets, to the banking system at 0.25% for 3 years. That provided a lot of relief from the banks in terms of their funding costs, because in the global capital markets, funding costs had risen quite sharply, particularly the gap between private borrowing rates and government bond rates. So that took pressure off the Australian banking system, and they're also expecting that more money will be available if the banks are prepared to lend more money to the small business sector at those rates. However, the indication is that that money will not be available if the money is being lent into the housing market. What success has the Reserve Bank had with these policies? Well, we've certainly seen a restoration of stability in the government bond market, because it had been dysfunctioning prior to the Reserve Bank indicating their preparedness to enter the market. Secondly, we've seen a substantial contraction in the margin between private sector interest rates and risk-free rates, and that's been due to the boost in liquidity that the Reserve Bank has provided the financial system. They've been able to achieve that by aggressive open market operations, which has restored liquidity into the short-term money markets, and also purchasing $37 billion of government bonds, including semi-government bonds, right across the yield curve spectrum. Yesterday, the Reserve Bank board met, and of course we were not surprised to see that they confirmed their 0.25% targets for both the cash rate and the 3-year bond rate. We're going to have to get used to that being the result of board meetings for some years to come. They also indicated that they were happy with their success in restoring liquidity and stability to markets, and anticipated that their intervention going forward may be allowed to be somewhat less. I was a bit disappointed that they did not give us a view on the outlook for growth. They talked about a very large contraction in the June quarter, and the fact that the unemployment rate would be higher than we had seen in many years. In this presentation last week, I indicated Westpac's forecast that we expect that the June quarter GDP will contract by 8.5%. Over 2020, the economy will contract by 5%, including an encouraging 5.2% recovery in growth in the December quarter. We also indicated that without the job keepers package, that the unemployment rate was likely to have reached 17% in the June quarter. With the package, we expect that it will peak out around 9%, still well above historical levels, but a much better result given the likely effectiveness of the package. And we expect that by the end of the year, the unemployment rate will have fallen to around 7%. We also indicated last week that they expected that the government bond supply would have to lift by $310 billion over to 2020 and 2021 to finance the stimulus packages that the government's already announced, and also in recognition that the cyclical deficit in the for the budget will be substantial, reflecting those very sharp job losses and the very sharp economic contraction. Overall, we expected that over those 2 years, the government bond supply would have to increase by $310 billion. That's nearly a 60% increase in the current level of outstanding bonds. So of course, while the Reserve Bank feels comfortable that they've been able to restore stability and be able to achieve their yield curve targets with their $37 billion worth of purchases so far, the challenge is going to be much, much greater for them over the rest of this year and next year when the supply is boosted so substantially. And consider next year when we expect that optimism in the world economy will certainly have improved, and at a time when people will be raising their outlook for economic growth, will be a time when the market will be receiving this huge injection of new government bond supply. That's going to provide a big challenge for the Reserve Bank if they want to maintain control over the whole yield curve. My expectation is that the success in the short end of the curve will be sustained, but we may see longer term bond rates rising with the Reserve Bank not being prepared to allocate the sort of resources required to hold down the whole curve. Thank you very much.